So you've done everything right to enter what looks like a great trade. But the stock doesn't move. It just sits there and sits there and sits there. What the heck is going on, you think? Go up already. You wonder, should you exit? You wonder, should you add? Should you hold? Most traders really struggle with this part of trading, and that's because they don't have a structured game plan for guiding their decision making. But in this video, we're going to share a game plan our traders use to help them make the best trading decisions in these situations. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
You've researched the idea to understand the catalyst. You know the support and resistance levels to understand the quality of the setup. You watched this stock setting up and saw that it was in your playbook. You showed the patience to wait for a good entry to present itself. You kept that sniper mindset. You had that focus of an elite performer to let your trade be presented to you. You're in an amazing position to make one good trade. You've done so many things right. Now, this is just the price of admission to elite level trading. You put yourself in an incredible position. But now what? If you've done all the work, you've done everything right, what now? Trading's sort of like poker because of the bet sizing. Everything you've done right to get you to this hand, but we still have this edge relative to poker, relative to any fixed bet games, as the EV, the expected value, is constantly changing. And unlike poker, and unlike so many other things, we get the chance to change our bet sizing to match the changing EV. We don't have to bet anything if the trade doesn't trigger at the right time. We can reduce size if the trade doesn't start to work in the right time. We can add, and we can really increase the profit potential of this trade if the stock does what we expect in the time we expect, because that just shows us that others are betting the exact same way. So what are we really talking about? It's about having a process to get rewarded well for the great work we do to get this seat, to get this hand right in front of us. This is why we have a shot clock for every trade. So what's a shot clock? A shot clock is simply the time it takes for a trade to start doing what it should do if you're going to get a really good opportunity. If it's going to be a trade where you get a chance to get paid, or a trade that you should just not invest much more in, you shouldn't invest any more emotional or financial capital. This is just a systematized guide to know when to make a trading decision and what type of trading decision you need to make. Shot clocks can be used for entry and for reasons to sell. On entry, we're specifically looking at our shot clock specifically is the gap, the time it should take between the trade setting up and that setup hitting us between the eyes, and then the trade actually falling into our lap and giving us an entry. For reasons to sell, it's that super important probability variable in the EV equation. Overall, this is an indication that other market participants are acting in a way, either buying or selling, with our idea. Now we're going to go through examples. We're going to study different types of trades, starting with how to look at higher time frame trades. What's a shot clock look like for a swing trade? These are measured by hours and days. So we're going to look at what hours and days might look like for a shot clock in a swing trade. Then we're going to jump into intraday trades to hold, where we can use a shot clock that's on 5-minute or maybe even 15-minute bars. We're going to get even shorter with our shot clock and look at how it applies to move trades, looking at a 2 to 5 minute shot clock. And then we're going to reset our shot clock to seconds or maybe 2 minutes at the most and look at scalp trades. Finally, we'll drop our shot clock down to almost immediately, almost no shot clock at all, and look at some tape scalps. We're going to use bar by bar work to go through specific trading setups for each of these. We're going to walk it right up to the point of a shot clock going off, and we're going to talk about the trade decisions we need to make there. Overall, this is going to provide a guide for different ways to make different trading decisions at the right time. Before we jump into that, let's cover the trade decisions you can make at the buzzer when that shot clock goes off. What are the actions that you can take? Okay, quick summary. We can enter, right? We can enter because that gap between that setup hitting us between the eyes and the trade falling in our laps meets the appropriate amount of time. We can exit a trade. We can exit when the probability has changed so much that it really would be like an unforced turnover, an unforced error if we kept holding our full position. It's kind of that point where the edge in the trade turns into hope in the trade. We can exit and we can ask ourselves if something's really changed in the trade. We can exit the entire trade. We can reduce our position. We kind of tend to reduce when it doesn't really not work. It's kind of an odd concept, but it's when the trade hasn't really worked, but it hasn't not worked. A general good rule of thumb here is to reduce our size by half, and we'll just kind of reset the shot clock at that point. Finally, we can reduce our trade by 90%, and we can let the entire trade reset. We kind of stay engaged, but without any real risk on. We think of it like a loose ball on our side of the court. We need to play defense here, but we're going to stay there just in case it kind of falls back into our lap. Okay, finally, we can add. So if the shot clock lines up, if the price action meets our criteria and it works in the time we expect, our EV, our expected value in the trade, that beautiful equation we use, has actually gone up. It can be really uncomfortable to add. Here are a couple ways you can do that. You could start by just adding 10% to your trade. This is an easy way to grow as a trader. It's an initial first exercise. When the shot clock lines up with the price action and everything's going in the direction you want, even just adding 10% can totally change your trajectory as a trader. For those that are really aggressive, we can double up. This is when you really see it. It's often like kind of an entirely new trade gets presented to us, but we have a reason to double our position. Finally, the most advanced concept, and the one we like to talk about the most on the desk, the double-double, right? This is an advanced level concept, but it's when everything lines up. It's a really easy money trade. It falls into our lap, and we have an opportunity to double our position and then double it again. Let's get into the different types of trades and the different shot clocks that we're going to look at for each of those trades. Let's start with the swing trades. This is the longest time frame we typically look at, right? Swing trades, typically on our desk, we're thinking 2 or 3 days. We're looking at either a changing fundamental catalyst or typically a very higher time frame break out of a really important range. These are the two big ones. So we're going to look at one of each. Let's start with a changing fundamentals catalyst, which is leading us into a swing trade. So we're talking about a changing fundamentals swing trade. This is when it's a 10 out of 10 catalyst. The most important catalyst you can get, something that should fundamentally shift the valuation of the company, not just in our minds, but in other participants' minds as well. So AMD had this news, and we deemed it a 10 out of 10 catalyst. We've already done a playbook on it, so if you want to check that out and understand more about the catalyst, that's not really the purpose of this conversation. We're going to talk about exactly what we're looking for. So our shot clock on this trade would be essentially this day, right? So this was the catalyst day, and then we're going to move it 1 day forward, okay? So we're going to think about, we're going to enter our entry for a changing fundamentals swing trade would be if it gets above the prior day close. In this case, we had a gap down, which was kind of unique. You can have different points of entry depending on the setup, but this one, when we see it move forward, we actually had a gap down. So our entry trigger was if we get above the prior day close. And our stop would be the prior day low. We're going to move our shot clock forward, and you can see what happened. Okay, so we enter. And essentially, if it didn't close at the high of the day, our shot clock would be done, right? Our shot clock, we're talking about it day by day, right? So we have this finite period of time where we expect something specific to happen. What did we expect to happen? Because of the quality of the changing fundamental catalyst in this name on that prior day, we expected that other participants are going to be buying this stock as well. So we expected that it would close at the high of day. If it did not close at the high of day, the shot clock is going off in our mind and we have to make a trading decision there. Let's move it forward. Now we're actually getting follow through. Okay, what's our shot clock thinking now? Okay, so we definitely need to move our stop up in the trade and we want to move our potential target. So if our target's right up here into this resistance area for initially half of it, we want to see what happens next. Okay, we get a pause day. We don't really have anything that we need to do. The shot clock is still running. The shot clock is following us up, but there's nothing that we should be doing at that point. We get a gap up and a close at the low of the day. We get a run right into resistance, and then it closes at the low of the day. That's a shot clock reason to exit. It doesn't matter what happens for the rest of the trade, but a gap up, a run into resistance, and a move back lower, that is a reason to exit. That is the shot clock telling us. It's so weird to think about using a shot clock on a daily chart for us, but that is the reality of what can happen. We have our reason to enter, which was that it took out the prior day close. That was the first thing that could have triggered on the shot clock. We had our reason to exit the trade. In this case, a move up into resistance and a close away from that. We never really had a chance to reduce, and we never really had a good chance to add to this trade. But all these things lined up perfectly for us. So it's a very simple way to cover this trade. Let's go to another swing example. So we're looking at UPST. It had a gap up on earnings and a strong move lower after earnings. We're looking at what happens here. This is a technical breakout trade. You can see it failed right at resistance. So now we're going to talk about what's our shot clock once the trade gets triggered. What would our shot clock be to enter the trade in general? It would be a break above that resistance level and a close at the high of the day. Let's move it forward one day. Okay, we get a break above the resistance level on volume with a close above the high of the day. We've had our entry trigger. The shot clock's running. How long can we give it to go somewhere? Well, typically you would hear people say, well, your stop's below the low of the day. We can do better than that. Our shot clock can tell us that with this type of move, we can get a day or two of pause, but by the third day, it should be taking out the high. 1 day of pause, and then it takes out the high. What's our shot clock telling us now? Essentially, it's telling us that we shouldn't take out this low. We should start to be going higher. And we want to be aware that if we don't keep going higher, our shot clock can get tighter and tighter and tighter. Oh, we have a really, really nice move. Okay, now we're getting that really nice upside follow through. So now our shot clock can be either half back or below the low of the candle. Okay, we get half back. What do we get? Okay, we get a follow move. All right, so we're still in this trade. Now we're starting to see volume, capitulatory price action. We're seeing this real extreme move very quickly. Now we get a topping tail. That's the end of our trade. It's a very simple technical breakout trade that we can just use a shot clock to tell us what should happen in a specific period of time. And then we take the trade and we move on when it's done. Again, we waited for our entry. We had the very clear defined period of time in which things should happen. And in this example, they did happen. So we followed our plan. And then when we had a very clear reason to sell, we took our exit. Now we're going to go intraday and we're going to talk about trades to hold. Trades to hold, we measure in 5 and 15-minute periods. We're going to look at AAP, which was a changing fundamentals trend trade. This was a trade to hold. It wasn't a swing trade for us. It was a trend trade, an intraday trend trade. Our entry will cover, and then we'll talk about a range break, a big dog consolidation trade, which is another trade to hold. So let's go into these. We're going to look at them on a 15-minute chart. So we're coming into the open. And for a changing fundamentals trend trade, this is when you have a pretty solid negative catalyst, but it's day one of the negative catalyst. This is where we look for a changing fundamentals trend trade. You can see on the daily chart, the trend was to the downside. And then intraday, we had a negative catalyst. I think we scored this as a -9 out of 10. And then we're looking for that trend to continue to the downside. So we'll go bar by bar here, talking about what our shot clock should be. Our shot clock for entry, just because we have the setup, we still have to wait for the entry, is going to be a back through open or a through the pre-market low. Those are our two options for our changing fundamentals, trend trade entries for this. So we get the first move up. Then it comes back down through the open. All right, we're in our trade. Where's our stop? If it starts to hold above the high at all for a 15-minute period, we need to be out of that trade. If it doesn't start to move lower after 3 15-minute bars, we need to be out of this trade. A stock can consolidate sideways, particularly when you're looking for a trend trade to the downside. But if it just holds sideways and doesn't start going lower, our shot clock has to be going off. So in this case, we're looking at 3 15-minute bars. Okay, we started to go lower. So what's our shot clock telling us? Our shot clock is telling us we shouldn't really give it all the way back to the top of the range because we should start to see that trending price action take over. We're seeing that move lower again. We're seeing that move lower again. Okay, now we're getting some really nice trending price action. Now we're starting to see some extension to the downside. What's that telling us about our shot clock? Okay, our shot clock is getting tighter and tighter and tighter here. We want to look for that continuation. We want to see it not be able to get higher. And as we close the day, we can exit our position because at this point, the trade has gone sideways and down into the close. This is a great example of how a shot clock can help you get your entry and manage the trade knowing what you are expecting to happen. Okay, now we're looking at a big dog consolidation in Tesla. This is one of the favorite trades of traders on our desk. What it is a big move up, long consolidation, continuation to the upside. So we've got the up move, and we've got this nice consolidation starting to form. We're looking at it on a 5-minute chart for this. Again, trades to hold, we can manage on a 5-minute or on a 15-minute shot clock chart. So we've got this nice consolidation that's starting to set up. And a big dog consolidation is when you actually, and the trigger for it is when you actually get the break of the high. So we get a pull it. Now what should happen? Well, really, given the price action and the reversal, it shouldn't take more than 4 or 5 5-minute bars, that's about 20 minutes, for us to get continuation to the upside. We have to have that in the back of our mind. 4 or 5, 20 or 25 minutes of consolidation is about what we can expect after we have a pullback, after the low of a potential consolidation is put in. If it just starts grinding sideways, we probably don't actually have that big dog consolidation, so we'll never get a reason to enter the trade. So let's move it forward slowly. Oh, wow, it went right there. So we entered the trade. Okay, so we're long. What's our shot clock telling us? Well, if it comes up and it doesn't move in 2 consecutive 5-minute bars, if it doesn't move any higher in that 2 consecutive 5-minute bar period, well, this thing probably isn't going to go higher and it's probably going to trap and go lower. So let's watch this through. We've got 2 5-minute bars as our shot clock. 1, and then it started to move higher, which is great. It's doing exactly what it should do at the time that it should do it. So we're just sitting in our trade. We don't have any reason to make any trading decisions. It opens and goes higher again. Once again, we close at the highs. Then we keep closing at the highs. This is really not giving us any reason to do anything. What would give us a reason? What's our shot clock now? Well, it shouldn't really go sideways for more than 5 bars. So if we get a 5-bar sideways consolidation, that's 25 minutes because we're looking at 5-minute bars. That's our reason to get out of this trade. It can consolidate a little bit, but it shouldn't consolidate for more than that period of time. There's our 5th bar. If it doesn't go higher here, we can move our stop right to the low of this consolidation, and we might get stopped out of the trade, but that's okay. Okay, it's starting to move higher. Okay, now we can recognize that we're in a little bit of an extended move. So we can start to think about our shot clock in this trade is that it needs to get going higher fast. And if it doesn't, we're out of this position. Again, our shot clock is getting shorter and shorter as we get further and further into the move. Okay, we get a little more extension. That's great. Okay, now we're really starting to get pretty extended. So we either need to move our stops to the lows of the prior 5-minute bar, because if this reverses, we can expect it to reverse very quickly, or we can just continue to trail it up very, very aggressively using the tape as our guide. Okay, we get a really nice extension to the upside and a close to the upside. And then we get it, there we go. We get this up move, up move, up move. Our shot clock keeps getting shorter and shorter and shorter. If we get any sort of reversal, we're out of this trade. And we're out of this trade. Very simply put, this is how we use the shot clock to our advantage for an intraday trade to hold. Let's go to move trades. These are often the most confusing, and this is where the value of the shot clock really does come into play. So we'll talk about these on an intraday basis. These are measured in minutes. Typically 2 to 5 minutes is about the time we're looking at in these. You know, I tend to be on the shorter side of it, but we argue about this on the desk all the time. Some people think you should be on a 5-minute, but I like the 2 minutes. So let's take a look. Okay, the trade we're talking about in this move-to-move trade is a VWAP stuff trade. This is one where we get some sort of move in a direction, and then we retrace to VWAP, and what we're looking for is a distinct stuff to occur. When that stuff occurs, we need to see the price action start to go lower quickly. We're using a 2-minute chart here. So our shot clock is essentially 5 minutes. That's 2.5 bars. You could say 3 bars, that's perfectly fine. But our shot clock is once that stuff occurs, that gives us our entry. If in the next 3 2-minute bars, 6 minutes, if we don't start moving lower, we have to check out and be done with the trade and kind of give ourselves a chance to reset. So here we go. We haven't gotten the stuff yet. You see that little bit of a rejection right at VWAP. We're still looking for a distinct stuff. We get the up move, and then there's the stuff right there. You can see we opened, we went up to the highs, and we closed back at the lows. Now we're coming in with volume. So what do we expect to have happen? Our shot clock, price may hang out here for a long time. If it does, then our shot clock has been met and we can reduce or we can exit the trade. If it starts to go lower quickly, we can add to the trade if we want to. That's exactly what we expect to happen in that VWAP rejection trade, VWAP stuff trade. So we're going lower, so we can actually add to the trade here. But what do we expect to have happen? We expect this move is going to continue lower quickly. So even using 2 minutes, we can again look for 3 2-minute bars and use our shot clock there. Okay, we move to low of day. That's exactly what we want to see. Now let's see if we get 3 2-minute bars going sideways. That's pretty close. So this is almost our shot clock being up. Now we get to make a decision based on the next candle alone. Okay, we continue to the downside. All right, great. Now our shot clock is that we should continue lower. And if we don't, we're out of the entire trade. That's our reason to sell. We pop up and we're done. We're done with this entire trade. That was our reason to sell for this. It's that quick in a move-to-move trade sometimes because the trade just sort of moved and then it paused and then it moved again, but that move didn't follow through. So as we're updating the shot clock with the move, it gets tighter and tighter and tighter. We exit our position. So we're talking about this really nice 5:15 move-to-move trade. A 5:15 move-to-move is essentially just defined as 5 15-minute bars are going sideways at the low of the day. This can also occur at the high of the day. One specific clue that we want to see is if there's an attempt to break higher, which we happen to get here, we want to see at less than 5 2-minute bars, because we're trading on a 2-minute chart here. We want to see it take less than 5 2-minute bars for the price action to get back lower. If it goes up and holds sideways, we don't have this trade anymore. Even if it's kind of holding right there, we really want to see the sellers take back control. Again, this is before we even get our entry trigger. Our entry trigger is defined when we get below the low of the range. So let's move it forward and look for the entry trigger. Okay, we get a down move. All right, we have about 3 or 2 bars before we need to start getting lower. We move sideways 2, and then now we can enter our trade to the short side. It's doing exactly what we expect it to do at the time that it's expecting us to do it. So our shot clock is going off telling us this is doing what it should do. We're getting this nice move to the low end of the range, and as long as it stays down there, that's perfect. Our shot clock is allowing it to breathe a little bit, but it's also telling us if it doesn't start moving to the downside pretty quickly here, we need to be out of this trade. It's just not doing what it should do in the way that we expect it to. As it's moved lower, we can start to tighten up our shot clock. Every single really green pop bar, we want to see the sellers start to take control again. And in this case, they do. As we start to accelerate, our shot clock gets tighter and tighter and tighter. We want to see that acceleration really pick up and really continue, and it does. And at this point, we're getting pretty far extended in the move, so our shot clock is really, really tight. We get some nice volume there, and then we're going to look for 2 green bars or a takeout of the prior high, and we're going to be out of the trade. So our shot clock continues to tighten, continues to tighten, continues to tighten. All right, now we have 2 consecutive green bars. We can be out of the trade. That's the end of the trade for us. That's perfect. Now we're going to get down even tighter. We're going to talk about scalps. Scalps are trades that should work. Our shot clock essentially can be seconds or minutes at most. We're going to talk about one of my favorite scalps, which is the second chance scalp. So a second chance scalp very quickly is you get a move in one direction, you get a quick retracement right typically to that area where the break occurred, the range break occurred. In this case, we're going to be looking at a downside move, quick move up, and then as soon as we get our trigger, as soon as the price action starts to turn, it really only has about 2 minutes before it should start to go lower. Our shot clock can be very, very quick in this scalp. I really like an example like this. Let's move forward. We get the break right to range and we get a pause candle. That can tell us to enter our position. What should happen next? Well, as soon as we start to go lower, our shot clock is very, very, very quick. If we get even one move higher, we're done with this trade. We start to go lower even more. This is great. Now we can update our shot clock where if we don't take out the low of that range, we're out of the position entirely. We get that nice extended move. As we extend, our shot clock gets tighter and tighter and tighter. We can move essentially our shot clock to every 1 minute bar being the guide. If you're watching the tape in this, you can make a really good decision here that, okay, if we don't go lower very quickly, I'm out entirely. So this is our first move higher. This is our reason to exit this trade. So our shot clock had guided us and helped us maintain that trade so we could capture more of the EV of that trade. Then the price action balances. As it balances, we're thinking, do we have a chance to re-enter a trade? What we want to see is a pop up, and then we want to see that pop up start to fail quickly. Again, we have the setup we want now. In order for us to be able to take a trade, we need to see the price action do what we expect it to do relatively quickly. Okay, it rejected and then rebid. It kind of went up. Let's see this change now, and we can enter right here, and in the next 1 minute candle, we can make a trading decision. If it doesn't start to move lower, we're out of the trade. Okay, now we're into tape scalps. Tape scalps are the quickest trading decision scalps you could possibly make. They're usually things that you see that are distinct on the tape. In this case, we're going to look at a held bid that drops, and we're going to talk about how quickly our shot clock might really go off for that trade. So we're going to look at this held bid at ACON, and this is just a very straightforward example that we'll use. This really could be applied, the same concepts could be applied to any sort of held bid, held offer, any sort of round number breakout. This is how fast our shot clock should be for something that is a tape scalp. So we can see there's a held bid right at 120. 120 won't drop, 120 won't drop. We can watch the bid over here. We're going to let it play out a little bit. But then when we see that 120 drop, we're going to talk about what our shot clock should look like for this. Okay, so we're seeing that giant bid at 120, 120, 120, 120, and it drops. Immediately, we're in our position, and our shot clock is seconds. If it didn't do exactly that, then we don't have any business being in the trade. This is a perfect example of when your shot clock is immediate. If that 120 wouldn't have dropped more aggressively, we would have to be out of the trade. We'll let it play out, let it play out, let it play out, and we can move our stop down with the trade if we want to. But let's review that one more time, because that is so abrupt, and that is exactly what you need to have happen in a tape scalp in order to stay in a tape scalp. All right, we're watching it again here. That 120 bidder is sticking the bid. That's a held bid. This is the same concept that you'll see across so many other things, but you want to see it hold, 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 and then when it breaks, it really needs to break. Your shot clock in this is almost immediate. It is truly measured in seconds or milliseconds even. Usually seconds is fine. But when you see something break, you want to see it break right away and start to move in your direction quickly. See the 120, 120, 120. There's the bidder. As soon as you see the prints start to go through at 120, you want to be aware. We're at 121 again, 121 again, 121, 120, 120, 120, boom. We want to see the offer step down. That steps down immediately. We want to see it following through to the downside. That's how quick our shot clock can be for a tape scalp. We can enter the position our fingers are right on the keys. It's two hands on the wheel, and we're expecting the price action to start moving lower quickly. It does that. That's great. Now we can stay with this trade, and you can see as we move it forward, the price action continues to extend to the downside. And we can use the shot clock can be guided by the moving average, or it can be guided by something else. But we wanted to highlight this to see there's so much misconception about what a held bid should look like when it drops. That is a great example of how quickly a held bid should drop and how quick our shot clock can be in guiding us on to make the right decision, and especially for a held bid or dropping or a held offer getting cleared, how quickly we need to be thinking about if something doesn't happen right away, we're just out. That was probably more examples than we wanted to cover or needed to cover, but this is such a critically important part of making really good trading decisions for your playbook. So in review, let's make sure that you know your playbook, and your playbook includes setups from other traders. Ask them. You can challenge them to help you develop a shot clock for this trade. If you learn a trade from somebody else, ask them what their shot clock is in the trade. If they don't understand it, explain to them very quickly what a shot clock is, and they should be able to tell you exactly what their shot clock is in every portion of that trade. If they don't, challenge them to build one for themselves. This is really just an extension of studying your playbook and increasing your ability to capture those high EV moments. This is a practice to reduce variance in your trading. It's a practice that helps you lose less, and it puts you in a position to make more. It's really a way to preserve your mental capital and financial capital for the moments that you're really going to be right. When others are seeing and acting in accordance with what you're seeing and what trading decisions you're making, those are the moments when we make a lot of money in the market.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7, and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training.
That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.